Bill has said that I cannot say that everybody in the Federal Reserve System, incoming and outgoing chairman, call him first, but I can say that they call him second to ask, where's the economy going and what can we do about it? Bill Strauss from Chicago Federal Reserve. Thanks.
Okay. All right, thank you, Jay. And it's my pleasure to join you and in about 15 minutes try to run through what I see happening for the U.S. economy. The story I want to share is a story of good news and bad news with regard to the U.S. economy. The good news first. When you look around the world, you see Europe that is just emerging out of a recession. Growth prospects are, all in all, still very restrained. Growth in Asia and in Latin America appear to be softening. Japan is trying to stimulate their economy, and while they've been successful with regard to some of the price measurements, they have yet to really get growth to be doing as well as they would like. So in light of all of this, and I would say that the U.S. economy appears to be the strongest economy in the world. Now the bad news. The U.S. economy appears to be the strongest economy in the world. My clicker is not working. There we go. Because when we look at how growth is doing, we don't have fourth quarter data yet, but on a third quarter over third quarter view at this point, growth in the U.S. economy has come in at 2%. This is right around what we think of as trend growth for the U.S. economy. So yes, we're growing, and the growth is decent, but by no means spectacular. Now, people can get excited on the fact that, well, the third quarter value came in at 4.1%, best number that we've seen in a long time. And certainly when you compare it to where we were in the first quarter, the improvement in the second quarter, and that 4% growth in the third quarter looks pretty good. Except when you decompose that third quarter number, I think it gives a bit of a pause to this view that things are accelerating. In fact, when you look at it, the key driver underlying that number was the change in business inventories, which contributed 1.7% of that 4.1%. Now, the question is, was that intentional or unintentional build? And I would put forth that, based upon my discussions and contacts, that a large part of it was unintended. In other words, producers kind of got ahead of what final sales were doing. And we have that statistic that's part of GDP accounting, which is final sales, which is GDP minus inventories, the change in inventories. And as you can see there, the growth continues, but that sense of acceleration is not in the numbers. It's continuing to show growth that is decent, but not spectacular. But there are some good things that have been happening. The housing industry appears to be on the mend. We are seeing home values that are rising. Here is the real price, took the National Association of Realtors price index, adjusted for inflation. You can see it's moving higher, but for those of you who have seen that double-digit gain and are thinking maybe things are getting ahead of itself, I don't think so. I think still, all in all, we're at levels that should not be too alarming. And the forecast, and now I'll be sharing a couple of forecasts. This is forecast from the Blue Chip Consensus Group. And the Blue Chip Group sees housing starts that are going to be just about 1.1 million this year, about 1.3 million next year. Still below the roughly 1.4 to 1.5 million that we think of our normal demographics would suggest for the housing market. So they are certainly suggesting that while improving, the housing market remains still out of balance through 2015. The stock market as well has shown improvements, and that certainly is helping out in the wealth effect for American households. But again, relative to where it has been, especially if you look at this over a broader period of time, it has kind of bounced around with a lot of volatility. We're at a high level now, but certainly not out of line in my opinion. So what's the outlook? Well, the outlook, according to Blue Chip, and this number came out on Friday, they are seeing growth of 2.4% for last year, so roughly a trend or just above trend rate of growth for the U.S. economy. This year, 2.8%. Next year, 3%. So the next year or two are going to certainly feel better than they have in the past couple of years, but I would say not incredibly better. The Federal Reserve has provided a forecast as well at the last December Federal Market Committee meeting, and their forecast, not too unsurprisingly, is not greatly different from blue chip, maybe a tinge higher, but that's basically it. Growth of this year and into the future of around 3%. Interestingly, we go out a little bit further because of the long legs of monetary policy. 2016, you can see actually the growth rate ticks down a bit. And I thought this was a very interesting observation from the consensus view of the Fed, because if anybody was thinking that, well, we have all this pent-up demand, all of these households that have not been formed, all the kids living at home with mom and dad, people living with roommates, and if we can just unhinge that, if we can just get a lot of activity back, we can see, instead of this kind of very good but not great, 3% growth, maybe we can get a 4 or 5% growth. The very fact that 2016 seemed to edge lower, to me, suggested maybe this is as good as it gets. And that, this kind of growth path that we're looking at is this we're going to have to deal with. And that maybe that pent-up demand gets sated by this relatively restrained growth. Let me illustrate what spectacular growth would look like. So here I'm taking the two previous deep downturns of the U.S. economy, the mid-1970s and the early 1980s. And I've indexed that to be equal to 100 at the trough quarter of GDP, as well as the current cycle in blue. And then I went out 17 quarters, just over 4 years. That would take us up to the third quarter of last year. And what we can see is that for both the early 80s and the mid-70s, after just over 4 years, growth in the U.S. economy was more than 1/5 larger. So our economic pie increased by more than 20%. That translates out into a growth rate of 5% and 4.7% respectively. That is spectacular growth. That is how you rapidly remove slack out of the economy. Well, after falling by more than 4% in the economy during the Great Recession, which lasted 18 months, at which point, during that period, we should have gone up by around 3%. That created about more than a 7% slack in the U.S. economy. Well, with all that slack, how have we performed? Well, unfortunately, over this 17-quarter period, all we've gotten back is 2.3% with regard to, is that my Corvette beeping over there? Okay. That's the government regulations, right, having the safety warning going on the vehicle. Anyway, 2.3% trend growth for the economy. To me, that would say that we still should have tremendous slack with regard to the economy. And I think you need to look no further than the labor market, which, we got the labor report on Friday, disappointing, only 74,000 jobs were added. But let's look at it over the longer time period. Well, we've added 7.5 million jobs. Isn't that spectacular? Well, it is, except if you ignore the fact that during the downturn, we lost 8.7 million jobs. We are still less than 90% of the way of recovering the lost jobs, which would bring us back to a level of December of 07 or early 08. So we'll get to that point sometime this year, where we've been adding jobs, 2.2 million over the past year. But keep in mind that every year since 2008, we have added over 1 million workers to our workforce. So even when we get back to the existing labor levels of 2007, we're still going to have large numbers of people unemployed. The unemployment rate has come down 6.7%, but as we all read on Friday, not for some good reasons. It was a fact that we have a lot of people who have left the labor force. And of course, this does not take into account those working part-time for economic reasons, those people who would like to work full-time, in other words, who are working part-time. That's 5 percentage points additional amount of unemployment or underemployment, if you choose. And it also doesn't even take into account the people who are underemployed, those college kids who have not found jobs in the fields that they have trained for. So the look, according to Blue Chip, is that the labor numbers will continue to move lower, but even 2 years from now, at the end of, say, 2015, we're still talking about unemployment rates that are above 6%. The Fed is not too different on that. In fact, we're going to have to wait till the end of 2016 to see numbers that are closer to what we think of as full employment. So even though we're likely to get back to record levels for employment in the economy this year, I'm just saying we're going to probably have to wait about 3 years before we can talk about a labor market that is anything close to being normal.